Welcome back. In case you're just joining Bulls and Bears on this Thursday morning here on Citizen TV, you're finding us just on time where we're heading into our next conversation, digital lending. And earlier on, before that, we had a fantastic conversation which we've just concluded on the budget policy statement. But right now, we want to dive into this one. Faisal is still around with us. He'll be sharing with us a couple of numbers.
We're taming the digital lenders. Faisal, what do you have for us?
Thank you, Trevor. Just before we get into the numbers, there's a question I want to pose to Kevin Mutusi, who is the spokesperson for the Digital Lenders Association of Kenya. There have been a lot of issues that the central bank specifically has raised with the digital lenders. Key among them being, these are some of the numbers. Oh, sorry, these are not the particular numbers. But just before we get the numbers, one of the key issues that the CBK has raised with you is on regulation. And one of the issues that they raised is that why are you charging such high interest rates? We understand that some of these loans are not secure. These individuals, you do not know them, but they termed some of the tactics that you're using as predatory. What do you have to say about that?
That's an interesting conversation that Faisal is raising right now, because you have a different set of guests now. So we're no longer talking about the budget policy statement. We're talking about taming digital lenders. Kevin Mutiso is a spokesperson, Digital Lenders Association of Kenya. Thank you for making time. Irenius Gishana, the board member, Credit Sharing Information Center, is also with us. And Reginald Kazutu is still here as well, a financial analyst. And there's a question from Faisal, Kevin, on why are you charging such outrageous interest rates?
Thank you very much for having me. That's a very interesting question, because we don't feel that the interest rates are that high. And the reason is simple. The cost of funds that we get them from banks, we get them from other financial institutions. And just the way you sell mangoes or tomatoes, we have to put our own price on top. So because we're in digital lending, which is very high risk, the cost of capital is very high. So if you go to the market and you look at what we're raising capital at, you'll see it's very high. I want to speak a bit about the regulation and what Digital Lenders Association of Kenya feels about it. The reality is that we do want to get regulated. We feel that regulation will not only bring sanity to the market, but it will also protect us as digital lenders, because there are certain risks that regulation protects us from, right? And some of those risks are around anti-money laundering, some of the practices you're seeing around collection. You know, we are being blanketed as that we're that digital lenders want to harm Kenyans, but it's certain parts of the ecosystem. It's not the whole ecosystem. From a regulatory point of view, we do want to get regulated.
Here's the thing, Kevin. So you had given an example where whether you sell tomatoes or mangoes today, you will definitely mark it a bit higher to earn profit. Basic mathematical equations. But here's the thing. You've just said digital lending has high risks.
Yes.
Then why are you targeting Mama Mboga?
Because the Mama Mboga is somebody who was never there in the ecosystem.
But
right?
This doesn't favor Mama Mboga.
It does. You see, what happens is, right now, for example, the tomato price is very high.
Yes.
Right? We're all talking about that. How many tomatoes does a Mama Mboga buy every day to sell to her customers? She spends maybe 10,000 shillings, right? If you charge 10%, that's 1,000 shillings on top. If you split that on all the tomatoes that she has, it'll be cents on the tomato, right? So this Mama Mboga is able to buy more stock. So before we existed, she was buying stock worth 5,000. Now we're able to give her an extra 5,000. She's able to make an extra 500.
The percentage of return from the loan that you give her doesn't allow her to comfortably do so.
It does. That's my point. It does. You see, the other misconception with digital lending is that we're looking at a Mama Mboga like a typical business. Businesses usually have 30 to 45-day trading cycles. What that means is that the company has 30 days of working capital before it's paid for its good or service. A Mama Mboga does not have that option. She has to go and literally pay her supplier the same day in cash, or sometimes it's 1 day or 2 day credit. What we enable them to do is get that extra stock, extra supply, so that they can sell to the market. And we are pricing fairly. In fact, if you read the FSD report, I think 2018 or 2017, it was very clear that pricing was not the biggest issue the consumer had, right? So the target market that we're looking at has 7-day trading cycles, 3-day trading cycles. So the Mama Mboga doesn't she wants our loans.
Yeah.
And if you look at even the results of the credit bureau, we have 11 million people on the credit bureau today. In 2016, we had less than 3 million people. So we've been able to create this credit story for our customers.
Okay.
We've never had before.
Irenaeus, is it fair pricing from where you stand?
I think there are two sides of it. There is one component that is you would call unfair pricing. There is one component that you would call fair pricing. We agree there are some lenders actually who are charging exorbitant rates, and I think those are the category. That's the category I would call.
Okay, I'll come to you in just a bit. I seem to be having a technical challenge with your microphone there. Kazuzu, what do you think? Is it fair from where you stand?
I think the question is what is exorbitant? We keep on coming and saying the interest rates that digital lenders charge is exorbitant.
Sometimes it's at 300% what you borrow.
Exactly, but a loan is a commodity which is moved by demand and supply. If there's more demand for it, you'll find interest rates will generally go up because there's more demand for credit. So interest rates will now start going, will now go up. Central bank has a tool to control interest rates, but the tool has been impotent, for lack of a better word, the CBR rate. It only had power when the interest rate cap was there. And if you notice something, when the interest rate cap was put, what did all the banks do? They started creating digital lending platforms, which were charging the same rates that the digital lenders are actually currently charging. So the problem is a problem of access of credit to the mamamboga, the boda guy, and whoever wants to do business. And when you have a squeeze on credit, we have what we call now shadow banking that starts coming up. China had a problem with shadow banking for quite a long time during their years of growth. Because the state institutions were not providing lending to the private sector, they were providing lending to the government sector alone. So if you want to see interest rates coming down, create competition from the formalized commercial banks. How do you create that competition? The government needs to stop borrowing everything that the commercial banks have, so that the commercial banks will now, they make money. So you are seated with a chunk of money on your balance sheet. Government is not borrowing. You will now be forced to go to Trevor and say, hey, Trevor, I have this money, I'll give it to you at 9%. The other guy comes and says, I have also the same amount of money, I'll give it to you at 7%. You'll find even the rates for the guys for the digital lenders will also start trickling down by itself. But we cannot regulate interest rates.
But also by these colossal numbers, if in 2016 there were 3 million and now they're about 11 million, it means there's something they're doing right, or is it just a desperate society?
It is a desperate society. If you look at the income, I think I mentioned it before that the real wage income for Kenyans has been stagnant and negative over the last 10, 15 years. If on average people are earning 55,000, but most of them actually earn below 55,000. If you look at the expenditure of that you have to pay for staying in Nairobi, you realize most people have to supplement their income by borrowing. The government is not creating enough jobs. The economic environment is not prudent or good enough for you to actually run a side business to generate additional income. So what do you do when you are faced with that position? You find you have to borrow for your transport, you have to borrow for school fees, you have to borrow. So people are actually not borrowing to, okay, there are people that are borrowing to drink and party, but majority actually borrowing for things which are pertinent. I need to survive. What do? I have to borrow.
Reginald, we need to throw it back to Faisal very quickly. Do you think that all digital lenders, the interest rates should be standardized?
Once you start playing with market mechanism and trying to interrupt and cap rates, whether in the formal or in the digital sector, you are literally playing with fire. And the problem of capping rates is because, one, we have seen what happens to the main commercial banks. Once you cap rates or start regulating the market, or the government starts becoming too involved in market mechanism, you destroy the market mechanism. When you destroy the market mechanism, at some point in time, it will come back and bite with you. For example, what caused the Great Depression, what caused the 2008 crisis, is when central banks decided we need to stimulate the economy, let's reduce interest rates. What did that do? It led to over-borrowing by the private sector and speculative borrowing. And that money ended up going into subprime mortgages because of that. And our dear governor was in the US during this period, but it seems like he's reading from the same script and repeating the same mistakes.
All right, Irenaeus, you're making a point on the issue of borrowing and regulation as well. Then we'll come back with Faisal after the break.
Yeah, maybe I just comment on that question.
Sure.
I think if you set a flat rates for all loans, I think it would not be the right thing to do. Mm-hmm. We need to allow the market forces to, to play. In lending, it's a risky business. And I think you need to allow the lenders to risk profile the customers. I think the issue is what's the start point for your pricing? Yeah. It's not practical to say a loan you're giving to a big corporate should be charged the same rate as the loan you're giving a small borrower. So when you put flat rates, I think it doesn't...
Back to your thoughts on regulation.
Yeah. Regulation, I think it's a good thing. I think Kevin has alluded that it's good to have regulation. One is to set standards. I think not all digital lenders are doing what you're calling predatory practices. Yeah, but we need to have standards to guide the whatever. So there are benefits of regulation. Number one is, you need to protect the consumer, obviously, from those that are overcharging the customers. You need to have best practices. For instance, transparency. I think we have some lenders who disclose the pricing of their products, their loan products. There are those that disclose. But I think when you come under the umbrella of regulation, you'll probably be more or less forced to disclose, be transparent, and for us in the banking sector, we are guided by the pillars of banking: transparency, ethical banking culture, customer-centric business models, and all those whatever. So I think when you bring all the lenders under one roof, it's the better thing to do, in my view.
Okay.
Yeah.
All right, we'll take a quick break. When we come back, Faisal Ahmed still has questions and also some figures and some statistics on this issue.